30-year fixed versus 15-year fixed. On the same $400,000 loan, the rate looks barely different, about 85 basis points. But the lifetime interest gap is more than $335,000. Today, the real cost difference and the cash flow trade-off most buyers miss. In 8 minutes, when a 30-year fixed and a 15-year fixed sit side by side on a lender's rate sheet, the spread looks small. May 2026. Freddie Mac's PMS reports about 6.85% for a 30-year and 6% for a 15-year. Less than a full percentage point apart. The mistake is comparing the rate. The real decision is almost always about cash flow, not rate. Same property, same $400,000 loan, two different futures. 30-year and 15-year amortization, both fixed rate. 30-year fixed at 6.85%. Monthly principal and interest is $2,621. 15-year fixed at 6%. Monthly principal and interest jumps to $3,375. The 15-year costs you $754 more every month over the life of the loan. 30-year lifetime interest is $543,498. 15-year lifetime interest is only $207,723. The gap is $335,775. That's more than the price of a small starter home. Saved by choosing the shorter term, doubling the term, more than doubles the interest. The math is not linear. Why is the math so much worse than it looks? On the 30-year, the very first payment splits, roughly $2,283 interest and $338 principal. Over 87% of the first month is interest. On the 15-year, the first payment splits, $2,000 interest and $1,375 principal. Only 59% is interest by month 60. Year 5. The 30-year borrower paid down $20,690 in principal. The 15-year borrower paid down $86,000. 4 times as much equity in the same 5 years. If life intervenes, job loss, divorce, a forced sale, the 15-year homeowner walks away with substantially more equity. There are real scenarios where 30-year is the right choice. For cases where 15-year would be reckless. Case 1. Tight cash flow with no buffer. If $754 extra per month would put you below 3 months of liquid emergency savings, the 30-year preserves the buffer. A foreclosure during a job loss costs more than $300,000 in long-term financial harm. Case 2. Investment alpha is real for you. A disciplined index investor can plausibly earn 7 to 9% long run on the $754 monthly difference over 30 years. $754 monthly at 8% grows to over $1 million, more than the $335,000 saved by going 15-year. Case 3. Mortgage interest deduction matters. If you itemize, the 30 years larger deductible interest reduces your effective after-tax rate. Case 4. You'll move within 7 years. Most of the lifetime interest gap accrues in years 15 to 30 of a 30-year loan. A short-term buyer captures little of the 15-year savings, so the 15-year wins when you'll hold long enough and your cash flow has the buffer. A common compromise: take the 30-year, then pay extra principal each month to mimic a 15-year amortization. This works with 2 caveats. The first caveat: you keep the 30 years 6.85% rate, not the 15 years 6.00. Even paying $754 extra, the higher rate adds $20,000 to $40,000 in lifetime interest. Second, discipline. The 15-year forces you. The 30-year asks you to choose every month for 180 months and refinancing from a 30-year into a 15-year. When does the math work out? 3 conditions for refinancing 30 to 15 to make sense. 1. You're at least 7 years into the original loan. 2. The new rate is at least 0.5 points lower. 3. Closing costs under 3 years of monthly savings. If all 3 hold, the Refi typically pays off within 2 to 3 years. Before committing to either term, run a 5-point checklist. Income coverage, emergency fund, years in this home, disciplined track record, and the after-tax math. Reality check. The average U.S. homeowner stays 7 to 13 years in a home. Most never see the year 30 finish line. On a 30-year loan, the interest tool lets you enter scenario A and scenario B side by side and see the lifetime numbers on the same screen. Enter your holding period and your monthly buffer to see the lifetime numbers. For your situation, what the interest tool provides is not which answer is right. It's what is the price of each choice, displayed on the same screen. Rate is not lifetime cost. Cash flow buffer, holding period, and discipline are the real axes. To summarize, 30-year fixed, $2,621 a month, $543,000 lifetime interest, 30 years of flexibility. 15-year fixed, $3,375 a month, $207,000 lifetime interest, $335,000 saved. What's your holding period and your cash flow buffer? Run the interest tool with scenario A and scenario B side by side. The lifetime numbers tell a story the rate sheet doesn't. PiPiWorlds.com/and/interest/blog/mortgage-term-trade-off-2026